More than half of young investors in America took money that was supposed to go toward their future, their retirement, their investing account, and put it into sports betting instead. Not once, regularly. And a quarter of them will tell you, flat out, that this is their financial plan now, not a slip-up, a strategy. Here's what's strange, though. This isn't a story about people who don't understand money. Some of these are the same people who, statistically, are saving more into retirement accounts at their age than generations before them. So something doesn't add up. Either the data's wrong, or there's a reason nobody's talking about. By the end of this video, you'll know exactly what's actually happening here. The real math on what this habit costs versus what investing could potentially have earned over the long term. And, more usefully, what a smarter version of I want to grow my money fast actually looks like, without pretending investing is boring enough to fix an urgent problem. Let's start with the number. A survey of 1,000 US retail investors, evenly split across 4 generations, found that 52% of Gen Z respondents had redirected money they'd originally set aside for investing into sports betting or prediction markets over the past year. Compare that to millennials, 31%, Gen X, 10%, baby boomers, 4%. This isn't a small generational quirk, it's a massive difference. And it's not necessarily casual. 14% of that Gen Z group say they do this multiple times a month. 26% call sports betting a deliberate, ongoing part of their long-term financial strategy, which is a pretty wild sentence to say out loud, because sports betting has none of the characteristics of a traditional long-term investment strategy. It's not diversified. It doesn't compound in your favor. It's a bet. To put the scale of this in context, Americans legally wagered close to $167 billion on sports last year. In 2019, that number was around $13 billion. Legal sports betting has gone from a fringe activity to a massive industry in just a few years, and it's now legal in most states. This grew up alongside Gen Z. For many young Americans, a betting app has been one tap away since they were teenagers, in the same way a brokerage app became normal for people who came of age during the rise of mobile investing. So why would someone choose the option that's mathematically worse? That's actually the real question. And the answer isn't simply, Gen Z is bad with money. Here's the math. Nobody puts on the poster. A broad stock market index fund has historically produced positive long-term returns, and a commonly used long-term assumption for real returns is around 7% annually. But sports betting works differently. Sportsbooks build a mathematical advantage into their pricing. Across a large volume of wagers, the sportsbook expects to keep a portion of the money wagered. The exact percentage varies depending on the sportsbook, market, and type of bet. But the fundamental difference is simple. One system can potentially compound your money over decades. The other is structured so that the house has an advantage over time. Gen Z investors surveyed weren't necessarily unaware of this trade-off, either. 8 in 10 of them said they believe these riskier bets can get them to their financial goals faster than the traditional route. And that may be the most important number in the entire story. Because the belief isn't necessarily, I don't understand investing. It may be, I don't have time. That's a completely different problem. And when you look at what's happening around them, that urgency starts to make more sense. Unemployment among younger Americans can be significantly higher than the overall unemployment rate, and entry-level opportunities have also faced pressure. Research has pointed to declines in some entry-level job postings, while AI is increasingly capable of performing tasks that historically gave young workers a way into certain careers. At the same time, buying a home has become extremely difficult for many first-time buyers. So imagine you're 24, you're trying to get your career started, you're watching housing prices. You're watching your friends struggle to find good jobs. You see people online showing off businesses, investments, cars, and lifestyles that seem impossible to reach through a normal paycheck. And then someone tells you, just invest consistently and wait 30 years. Technically, that's good advice. Emotionally, it can feel completely disconnected from reality. Most people assume the fix for feeling financially behind is patience. Invest steadily. Avoid unnecessary debt. Let compound interest work. Don't chase quick wins. And that advice is fundamentally correct. But there's a hidden assumption behind it. You have to believe that time is actually on your side. If you're 24, priced out of a starter home, applying for jobs that don't seem to exist in the same way they used to, and watching a system that's supposed to reward steady saving feel increasingly difficult to navigate, be patient and wait 30 years doesn't always feel like an opportunity. It can feel like a luxury other people get to have. And that's the deeper story. This isn't really just about gambling. It's about trust. Young Americans are increasingly turning to social media for financial information. For many of them, TikTok, YouTube, Instagram, and other social platforms have become part of the way they learn about money. That doesn't automatically mean the information is good. In fact, that's part of the problem. When people lose trust in traditional financial institutions, traditional career paths, and traditional timelines for wealth building, they're more likely to search for alternative answers. And those alternative answers often promise speed. Make money faster, get rich faster, invest differently, build income online, beat the system, swing for the fences. The problem is that speed and risk are often connected, and the internet is exceptionally good at showing people the upside while hiding the downside. Let's make this concrete. Say you're 24 and you have $200 a month that you could either invest or use for sports betting. If you invested that $200 a month into a broad index fund and achieved something close to a long-term historical real return of around 7% annually, you could potentially end up with more than $200,000 after 30 years. That's not a guarantee. Markets don't move in a straight line. Some years are positive, some years are negative, but the important idea is compounding. You put money in. Your investment potentially grows. Then your previous gains can themselves generate additional gains. Over decades, that process can become extremely powerful. Now consider the same $200 a month going towards sports betting. You can absolutely win individual bets. That's why betting is psychologically powerful. You might win today. You might double your money on one bet. You might have an incredible week. But over a large number of bets, the sportsbook's mathematical advantage works against the bettor. Same $200, same 30 years. Completely different mathematical structure. That's not a moral judgment. It's simply how the two systems work. But here's the part that should actually change how you think about this. Gen Z isn't necessarily behind on saving. Some research has found that Gen Z households, adjusted for inflation, had substantially more retirement assets at their current age than Gen X households had at a comparable age. So the saving instinct is there. The problem may not be discipline. The problem may be urgency. A generation facing higher financial pressure is looking for a faster path to financial progress. And sports betting is extremely visible. It's immediate. It's exciting. You can see the result almost instantly. Traditional investing is almost the opposite. You put money away, then you wait, and wait, and wait. The reward is delayed. For someone who feels financially behind right now, that delay can be psychologically difficult. So the real problem isn't simply Gen Z needs to stop gambling. The deeper problem is, what happens when a generation wants financial progress faster than traditional investing can provide it? That's where the conversation gets interesting. Because if the real goal is speed, simply telling someone to invest more may not solve the underlying problem. The better question is, how do you increase the amount of money you can invest in the first place? And that changes the strategy completely. If any part of this sounds familiar, here's a more productive approach. First, separate the goals. If you choose to gamble, never confuse that money with money intended for retirement or essential expenses. Treat it as money you can genuinely afford to lose. Second, if the real problem is, I need money faster than investing alone can provide it, then focus on increasing your income rather than increasing the size of your bets. A second income stream, a higher paying skill, freelance work, a business, or another legitimate source of additional income can potentially increase the amount of money available for long-term investing. It isn't instant. It isn't guaranteed. And it isn't easy. But unlike betting, the goal is to create additional earning power rather than relying on probability. Third, automate your investing. If money automatically moves into your investment account before you have a chance to spend it, you remove some of the psychological battle from the equation. Because sometimes the problem isn't that people don't understand the math. The problem is that the money is sitting in their checking account, visible and available when something exciting comes along. The biggest lesson here isn't that Gen Z is irresponsible. It's that people behave differently when they feel financially trapped. When the traditional path feels too slow, anything promising speed becomes more attractive. That's exactly why understanding the psychology matters. Sports betting can feel like a shortcut. Investing is usually a long game. And if you're trying to build wealth, the goal shouldn't be finding the fastest looking shortcut. It should be finding a strategy that can actually survive long enough to work. If you want the next video to break down exactly how I'd build a second income stream from zero with no experience and no money to start, the kind of thing that actually addresses the I need this faster problem instead of ignoring it, comment faster below. And if this video changed the way you think about sports betting versus investing, subscribe, because we're going to keep breaking down the real numbers behind how Americans are trying to build wealth.